if let's say we have a scenario where the S&P is up near 4,600 and the economy's open up and you're seeing numbers now of 6, 7, 8, 9% GDP, and you get inflation pushing up towards 3% or maybe even above, I don't think he can sit complacently and say, hey, we're going to let it run hot. So my guess is they do ultimately have to tighten. Might come later in the second quarter, or might be third quarter. But I think that's what kind of pushes that move up to 250. And I don't think it's necessarily, when I say tighten, I don't think it's necessarily going to be, hiking Fed fund rates or raising the discount rate. I think it's going to be mostly on the balance sheet side, pulling money out of the system. So, last summer when we didn't have any of this inflation, and when we were, barely a quarter from the trough, they pulled several $100 billion out of the balance sheet then, brought money back in. And I think, this time could be somewhere between 500 billion and a trillion. That has real consequences, ultimately for the economy, I think. So that's what I see for interest rates. In terms of